Hello and welcome. I'm Siddharth Zarabi and you're watching Modinomics on Business Today. Just a few hours to go before Finance Minister Nirmala Sitharaman presents the Union Budget for 23-24. The budget session has already kicked off. The Finance Minister has presented the economic survey in the Parliament today. The Eco Survey has pegged growth for 2023-24 at 6 to 6.8%. The economy is also expected to grow at 7% for the current financial year. That's what the survey says. And joining me now, Dr. Aurodeep Nandi, India Economist and Vice President at Nomura, India. Rahul, Bajoria, the Managing Director and Chief India Economist at Barclays. Shubhda Rao, Economist and founder of QuantEco, and Kaushik Das, MD and Chief Economist, India and South Asia at Deutsche Bank AG. What I want to do at the beginning of this conversation, and I must tell our viewers that we would like to look at what the budget is likely to hold for us. I'm coming to you, Rahul, on that one big number, 6 to 6.8 with a baseline scenario of 6.5. Explain that to our audience. What are the Finance Ministry Economic Service officials suggesting?
Yeah, so Siddharth, I think the number is possibly, a tad bit on the higher side. I would say 6.5 is something, slightly above what we think will be the growth. But broadly, I think it sort of paints a picture of resiliency in the domestic sector. I think one of the key messages in the economic survey that comes out is that from a financial sector perspective, the leverage in India has not really been increasing as has been the case with the West, but, it has actually come down relative to even the 2008 scenario, when we had the last round of growth, boom, which kind of ended. And so from the current perspective, with the headwinds of the pandemic, with the headwinds, even from the war and the commodity price shock sort of starting to fade through, India remains in a position to kind of grow, at a reasonably good rate of growth, which can be between 6 to 6.5%, which will be a very respectable number. And that should probably set us up, for a fairly resilient performance led by private consumption and private investment, which is starting to show some very early signs of recovery.
Rahul, that's a good perspective. Aurodeep Nandi, budget making at a time when the global environment remains significantly uncertain, although there seem to be some sort of green shoots, if I may use that word, on some of the dark clouds, if not green, at least a silver lining. What is the budget making exercise really about this time around? It is, of course, this government's in the current term last full budget, but keeping the political economy aside, what are the key challenges that you foresee?
So I think the first big challenge is just the optimism which the economic survey seems to talk of at 6.5% growth for FY24. Our number is much more conservative at 5.1%, because we feel that given the kind of recession that is likely to happen across developed markets, the hit to the Indian economy through exports, through a fall in fixed investments is going to be quite a lot. I mean, we are completely on the same page in terms of all these great reforms that the government of India has taken. And obviously, that's a positive medium-term story. So we expect growth to rebound in the next fiscal in FY25. But for FY24, it's going to be particularly challenging on the growth front. Let's also not forget that the RBI has sharply hiked its policy rates over the past few months, and there will be a lagged impact of this policy tightening also on domestic growth. The economic survey seems to talk a lot about private capex revival and hoping that will kind of drive growth. But for now, this is a very uncertain environment for hoping private capex to pick up. Now, with this scenario in mind, what kind of fiscal situation are we looking at? Well, look, the nominal GDP growth, right, which is real GDP growth and inflation put together, is going to be lower this year than last year. Regardless of whether you go with what the government of India is saying or a more conservative estimate, GDP growth, nominal GDP growth will be around 10.5, 11%. Come tomorrow, they'll put this for FY24. Now, this has two implications. One is that the tax revenues that were so buoyant in the last couple of years, which helped bridge a lot of the excesses on expenditure that happened, is not going to be there. That cushion isn't going to be there as much. So there is a downside risk in terms of just the amount that you expect out of taxes next year. The second aspect is also fiscal deficit as a proportion of GDP. The size of GDP, if it's lower, then the fiscal ratio is higher. This year alone, the fact that the nominal GDP growth has been higher than what is budgeted has helped the fiscal math to the extent of around 0.3 to 0.4% of GDP, which is not a small amount. On the expenditure side, I think, you've mentioned political economy, and I think that's going to be really important, whether, we recognize that come tomorrow or 6 months down the line. But I think what sort of comes out also from the economic survey, which is very interesting, is this focus on capex, right? And this kind of laser focus on getting more capex out of the door, and that seems to be at the heart of government fiscal strategy. Just one last thing. There seems to be a very welcome focus on fiscal consolidation. The economic survey talks about converting fiscal discipline into fiscal stimulus through lower debt, and that is positive. So, if you just go by the language we see today, possibly tomorrow we'll get a sub 6% of GDP fiscal deficit number. I mean, our baseline is 5.9% of GDP. It could be lower, but the question is really how achievable that number is going to be if growth indeed disappoints next year.
Shubhda, is the optimism with regard to growth justified, and what is the number that you are personally working with?
Yeah. Thanks, Siddharth. I think one critical point is the degree of optimism and not whether it's optimism vis-a-vis pessimism. So while we also believe that there is a reason to be optimistic, how much of optimism should we build in given the global environment is a key question. While we are within the fan chart, if I may say so, of what the CA presented earlier in the day, between 6 to 6.8, but I'm afraid we are at the lower end of the fan chart, which is at 6%, and not as the base case scenario presented by CEA at 6.5. So while growth definitely will start shaping up better as we see the risks, particularly coming out of the pandemic and some of the economic shocks having arisen because of war, namely the commodity price shocks or the supply chain disruptions, etc. Those perhaps would be waning, and to my mind that would be a positive factor to support India's growth. The reason why we are perhaps sounding less optimistic vis-a-vis the 6.5% growth is on two counts. One, of course, is the solid assumption on domestic consumption. Now, we have to here segregate the consumption pattern. While the urban consumption has remained fairly resilient and in fact looked better because of the pent-up demand and the economic conditions getting better with opening up of the economy. But at the same time, a fair bit of that domestic urban consumption has been leveraged. Interest rates having been rising over the last few quarters could perhaps somewhat slow this leveraged consumption. And as the credit numbers also point out, the credit growth has got a significant push because of the personal loans and retail loans and so on. So while we do see improvement in consumption, but how much of further improvement, that is a question for all of us to assess. The second is, I think the CA was candid enough to admit that private capex is at incipient stage. Right. Now, unless and until we see global economy stabilize, we perhaps may have to wait a couple of quarters or maybe until H2 of the fiscal 24 to see a more meaningful, broad-based private capex recovery. And for these two counts, we believe that growth may actually come out at at 6% and not perhaps at 6.5 as was
Okay.
taken as the base case scenario. But overall, I think there was a fair assessment by the economic survey in terms of the growth prospects going forward. Of course, with the caveat that there are no further one-off kind of shocks that we have seen over the past 3 years. But if the economy and within the global economic environment does not see any global economic shocks spilling over into the Indian economy, I think subsequent to fiscal 24, we could actually see growth getting better even around 6.5% to 7%.
Okay.
And I would like to stop there, maybe, take
Yes,
issues
absolutely.
later on.
Kaushik, thank you for waiting by as I complete my first round, which is more of a look back. And in the next round, we will focus exclusively on what should be the budget priorities. Kaushik, my question, in addition to whatever else you might want to say on the earlier round that we have had, is that the IMF seems to have suggested in its forecast that global growth may not be as bad as was earlier projected in its previous review. There are also other signs, including, for example, global CEOs who have been surveyed, where the level of optimism versus the pessimism, that ratio is also changing vis-a-vis what it was in November and December last year. Given the external macro environment, how do you see India being able to maintain its growth impulses? After all, it cannot just be left to the government to continue to spend because there is fiscal consolidation also, which all of you are calling for.
Yeah, so good point. One big change which is happening is that China reopening is happening at a faster pace than what we could have thought, say, a few months back. So you would have seen that IMF and all, private sector agencies also have increased the growth forecast for China. And therefore, obviously, China contributes a lot to global growth. And what we are seeing in Europe is also probably Europe can avoid a recession and, can, manage to grow a little bit in 2023 compared to what we are thinking that there'd be an outright recession. Even in US also, people were expecting maybe the recession to come sooner, but the expectation is now that if there's a recession, it will be in third quarter of 2023. So from that standpoint, the IMF has been able to increase the global growth. And just to give you a number, India's sensitivity to global growth is about 40 to 50 basis points. What it means is that if you have a 1 percentage point change in global growth from the baseline, either upside or downside, then India's growth can, change by 40 to 50 basis points. So if there is an upside surprise to global growth compared to what we thought 2 months back, then India's growth could surprise to the upside by 40, 50 basis points. Now, the thing is that we are working with a 6% growth estimate in real GDP terms. Can that become 5.5% if the recession turns out to be stronger? It easily can. Can it be 6.5%? That can also happen because, it all depends on how the global economy shapes up. We know that the global central banks have been increasing rates quite aggressively through last year, and there's still to go. Today, the Fed is going to hike rates. Bank of England, ECB, they're continuing to hike rates. And the issue is that if you think that, you can have a, not a hard landing and you can manage to keep growth out of recession globally, that will also mean that the Fed and the ECB will probably not hurry to cut interest rates. So there could be an environment where after the rate hikes, you could be stuck with a high rate for a longer period of time. And Economic Survey, I think, has made that point as well, that RBI can probably hike again in February. And then when the repo rate goes up to 6.5%, RBI may hold that for maybe, the whole of this year, which means that the private consumption element of GDP, which is 60% almost share to GDP, that can start slowing down. And therefore, on balance, even if the global is a little better than what we thought earlier, but the headwinds towards, private consumption, domestic demand coming out of higher interest rates, pent-up demand coming off, that can, on balance, lead to a growth of 6%. But 6 to 6.5 look, more or less realistic to start with.
Okay. Viewers, so far, the consensus seems to be, with all the four senior economists who are here with me, that it is more likely 6% and not 6.5, which is the baseline assumption. I want to come to you, Rahul, now and talk about the budget specifically. various ways it's been described, and the one that sticks with me is that Nirmala Sitharaman, our finance minister, has to undertake a fine balancing act. As part of that fine balancing act, how much should she balance the deficit?
I think, one particular aspect, every single budget has this, challenge between sort of choosing between consolidation versus supporting growth. But I think one thing that the government and the finance ministry particularly can take a lot of comfort from is that we have dealt with a lot of quite significant shocks through the last 2-3 years, with a fair amount of flexibility and also, a fair amount of responsiveness as far as being very targeted and very selective in terms of where we provide fiscal support from. I think this perhaps is the first budget. Last year it could have been the first budget, but we had the war that broke out just 3 weeks after the budget was presented. But this seems to be the first budget in a reasonably long time, where you don't necessarily are, having to kind of deal with a lot of contingencies, or, you have to kind of plan for a lot of issues which are going to be a specific problem to kind of handle with. My sense is that, the government is like the economic survey, the broad bias would be to ensure that you don't lose macro stability in an environment where, global growth appears to be reasonably uncertain. There is uncertainty around global commodity prices, and you are generally worried about, the nature of the growth recovery. So sustaining even a number like 6% probably is a greater priority rather than trying to push it up closer towards 7%, where it might look good, but then it might come off very sharply as well if, things don't go well. So from that standpoint, I think, the messaging is likely to be that keep things broadly stable. We have done quite well to deal with a lot of these, risks and challenges that have been thrown at the Indian economy. And the consumer and the private sector looks to be in a state to kind of lead this growth recovery, while the government plays, an enabling role in areas where private investment is not really coming in.
Okay. The point that you made about not losing macro stability, Aurodeep, I want to come to you on that if you would like to sort of dwell further on that point, and also your own sense about consolidation versus maintaining growth. Rahul, I think, made a very good point that thankfully so far, unlike the recent 2-3 outings, the finance minister has a reasonably clearer view of the horizon in terms of what happened last year or the year before.
Yeah, so again, this is a familiar debate that one has before budgets. Look, the incentive for the government at this point to give a bloated high fiscal deficit number, I think it's really doesn't. It'll be a departure from the kind of really level-headed macro management that we've seen the government do for the past few years. So I wouldn't be surprised, especially look, if you're talking of if as a government your baseline case is 6.5% growth, well, in that case, you would be expecting better tax revenues. So getting a more ambitious fiscal deficit target of say below 6% of GDP, that could be 5.9 or even lower. There shouldn't be a problem there. And I think there's also a kind of shift. It's not just the headline number. What will be also important is, how you reach there. So some of the things that we seem to hear in news reports is that the government had overspent a lot on food, fertilizer subsidies this year, primarily due to the Russia-Ukraine crisis. The government is looking to consolidate that sharply next year. And on the flip side, it seems to suggest that the government is really looking to ramp up capital expenditure. In fact, that's also what the economic survey seems to allude to. And the numbers out there seems to suggest that it will be maybe a shade over 3% of GDP, which is actually pretty huge if the government manages to get it done. So on the expenditure side, one would suspect that there will be a kind of a positive fiscal consolidation. But the key question for us really is, sure, you put out a number there tomorrow, but the key question that markets are going to ask is, will the government be able to walk that fiscal walk, right? So, you may say you have 5.7 or 5.8% of GDP fiscal deficit. Will that be achievable? And given that this is a year where possibly growth could disappoint on the downside, given that this is a very politically heavy calendar, there is risk that really reaching that, 6 months, 9 months down the line, maintaining the line on ambitious fiscal deficit target is going to be quite challenging. So I guess, yes, the number tomorrow, one expects it to be maintaining fiscal prudence, maintaining a lower fiscal deficit. But the key question will be whether that will be achievable over the course of the next year. And that, of course, is going to depend a lot on the way the economy shapes up, both domestically and globally.
Shubhda, lower tax revenue growth on account of a lower nominal GDP. I was just trying to recall the numbers, 15 odd percent previously, now projected at 11%, some people talking about 9 to 10%. How is that going to play out?
Yes, I think a large part of it is going to come because of lower inflation number in the forthcoming year. The current fiscal year, we are going to be looking at 15.4% as nominal GDP, which in our estimation would come lower at about 10% in fiscal 24, primarily because of the inflation trajectory that we are looking at. It is going to be a combination of consumer inflation and the producer, that is the wholesale inflation, wholesale prices. Now, WPI is likely to come in as low as 2% in fiscal 24, at least that's what our estimate is. So from inflation point of view, there will be lesser support to push the nominal GDP up, and commensurate to a 10% nominal GDP, I think we could look at obviously the lower tax collection growth numbers. For instance, what we saw in the current fiscal year is somewhere close to 15% growth. At least that's what we estimate, to be precise, at 14.7. What we are anticipating is somewhere lower than that at about 9.5%. So it is pretty much in conjunction with the lower nominal GDP projections that we are going along with in order to meet a consolidated fiscal number at about 5.8, where we see a fiscal consolidation of 60 basis points. Of course, this current fiscal year saw a very, very buoyant revenue collection through taxes. But on the flip side, we also saw a large outgo because of subsidies, because of commodity prices going up, fertilizer prices going up, therefore, and of course, the food security program. In the forthcoming year, perhaps it's going to be balancing out that we may not need these many subsidies because commodity prices have come off, and also the plan to discontinue with the food grain program that was seen earlier in the fiscal 23. So we will see lower expenditure to an extent, and it would be very important as to, as Aurodeep also pointed out earlier, that it would be very important to see how this expenditure is allocated. If it is targeted, focused, as has been the theme over the last 2 or 3 years, I think the benefits will continue to accrue. I think even Rahul also alluded to that. It's going to be important as to the quality of expenditure, and we keep saying this year after year, that what remains important is the quality of expenditure. So while government may be compelled to continue to focus somewhat more on capex versus pruning of revenue expenditure, overall, I think at least if we hold to our assumptions coming true, it may not be such a severe challenge to meet a consolidated fiscal number of 5.8. It, of course, the usual caveats do prevail as to everything else remaining constant globally, on commodity price, and no further escalation on the geopolitics side, etc. But over the last 2 or 3 years, we have seen the finance minister present fairly realistic and in some cases conservative numbers. The only, I would say, the black box that remains is the disinvestment proceeds. I don't think the government's for many decades have been able to meet those targets, it would be important to keep a track of how the government is budgeting for those revenues to, bridge some of the fiscal gap that we see between revenue and expenditure.
Okay.
But I would be not jumping the gun and be extra cautious that it's going to be difficult for the government to meet the fiscal number. I think going forward, reaching 4.5 by fiscal 26 is what one would be looking out for, because that would be more or less 2 further years of complete normalization. And even if you look at 11% nominal GDP, 11 to 11.5% nominal GDP growth over the next 2 years, how are we going to achieve 65 basis points each year of further consolidation to come at a 4.5? I think one would be also looking out for that part of the speech from the finance minister.
Kaushik, a large part of our expenditure remains committed. And therefore, the recent adjustment, I would call it, that was done with regard to the pandemic time additional food, free food allotment, that has been sort of reworked. Yeah. But Kaushik Das, the bigger issue is expenditure compression is politically not feasible in a pre-election year. We know, and these are anecdotal sort of data, we'll have to wait for it. For example, it is being said that the budget estimate of expenditure for the Jal department, the water ministry, it has not perhaps been fully utilized. The same story seems to be panning out across a few other departments. So from an expenditure point of view, what is the best strategy that you are expecting given the times that we are living in, Kaushik Das?
So, we keep on talking about central government capex. It's a very good thing that, the off-balance sheet items have been taken on balance sheet, and, they're now showing the whole capex expenditure of the central government, which has increased. The target is quite high for this year. Also, we need to think that just because you increase the target next year, you should be able to, kind of have enough projects to have, maybe 10 trillion of capex spending. You need to have that many projects, and you need to be able to execute in time to increase your capex every year. I think we are missing the bigger point that if you want, say, a growth of 6.5-7% in real GDP terms, it is the private corporate sector who has to invest. If you look at total investment in India, 75% share of that is private corporate sector, 25% is public investment. So that 25% public investment, is kind of growing at a very fast pace. The central government has done a lot of heavy lifting in the last many years. But obviously the private capex, which is what the CEA talked about, that last 10 years, they have not invested because of deleveraging issues. And then when the balance sheet cleaned up in 2019, 2020-21, we had the COVID wave, and 2022 now the capacity utilization has started improving, profitability improved. Now this is the time where you'll expect the private corporate sector to come in and invest in the next cycle for the next 5-10 years.
Right.
And that itself can lead growth to move up. Just imagine that 75% share
Right.
starting to grow at a faster pace. The government can do that much to support, and it's just a smaller share. The other big point is we are just talking about central government capex. The states also do a lot of capex, and in fact their share is higher than the central government. And the state government capex has not picked up in the pace that you have wanted to. And, so therefore the total capex could have been higher if the state government, did their bit of, spending. So that hasn't happened. So these factors are there. And the more important point that you said, subsidies, defense, and, interest payments itself kind of takes up 55 to 60% of total spending. So you can't have much flexibility over there. So basically what you need is, the tax GDP ratio to improve through organic, growth. And, that probably will happen with all the supply side reforms having been announced, GST having fallen in place. But this year you will have a problem of nominal GDP being lower. Disinvestments can play a big role if they can, succeed in increasing the number. But overall, I think you can achieve 6.5% growth on an average over the next 5 years. But the corporate sector has to kind of chip in and invest over the next 5 to 10 years. And I think they should. There's no reason why they shouldn't.
Okay. What I want to do, gentlemen, and I've completely run out of time, but I'm still going to push my luck. Very quickly, 30 seconds to each of you. What are the surprise elements that you are anticipating likely? This is the final question. Rahul, I come to you. Just quick answer. Any surprises that you expect?
I think the mantra will be, one where the transparency and the stability of the budget is likely to be retained. Don't think that there will be any unorthodox measures that will be rolled out. So I'm not expecting any positive, very big positive or negative surprises.
Aurodeep, the same one to you.
Well, I mean, it's a little bit of an oxymoron. If you expect it, then it won't be a surprise. But I think what's going to happen is fiscal consolidation, yes, etc. I think there's going to be a subtle consumption boost. So what I'll be looking for is sort of non-populist ways in which the government will look to support consumption. So it could be higher outlays, say for GNREGA. It could be tweaking tax slabs. So what kind of support you're giving to consumption, particularly at the bottom of the pyramid that has been hit by the pandemic and higher inflation. So I guess that will be the jack in the box for me.
Shubhda.
No surprise is a good surprise, but we will see focus on further financialization of the economy, PLIs and rural economy. I think these would be the three key pillars in the budget.
Kaushik?
A positive surprise, I think all of us would like to see, I don't know whether it will come or not, a little bit of cut in income tax rate. We
I was waiting. I was waiting for someone to say that, and I'm glad you said it, because for a wider audience, the bigger question is, since 2019, when that mid-course correction of corporate taxes was done, the middle class reeling under significantly high inflation, and inflation which is also not captured by our data sets, would be expecting some positive relief. There seems to be a buzz about that. For the markets, of course, there is also the expectation that capital gains treatment and the differential kind of approaches that are available might be looked at. But we'll have to wait for what Finance Minister Nirmala Sitharaman pulls out of that Bai Khata, as it is called, and in her fourth outing as the finance minister presenting the budget, we'll see what surprises she has in store, the good and those that may still surprise on the downside. Shubhda Rao, Rahul Bajoria, Aurodeep Nandi and Kaushik Das, thank you very much for your time with us today. With that, it's a wrap on this. We'll be back with more. Do stay tuned in. Goodbye.